Hello everybody and welcome to today's video entitled The Most Undervalued Growth Stocks in My Coverage Universe. New and improved with one new stock, Rover, that I've added in there. And it's been about 2 weeks that I did this video, so I try to not do it weekly anymore. But keep in mind that these videos are mostly for new viewers. If you are already a viewer of the channel, and that's about 30% of people who view these videos are already viewers of the channel, there won't be too much new for you because this is me sharing my portfolio with the crowd of YouTube at large. And I find that YouTube really promotes this video and this portfolio every time, and it's a way for me to reach new viewers. So if you're new to the channel, welcome to this video where I present my stocks to everyone and everybody who wants to hear. So if you're new to the channel, what do I do on this channel? Well, I invest on growth stocks, on hyper growth stocks on this channel. I want my stocks to return at least twice monetary inflation. Monetary inflation I estimate to be at 15%. Monetary inflation is the speed at which the US dollar grows. And I think, based on my analysis and my data, M2 plus euro dollar combined grows at a rate of 15% each year over the long run, which means that if I want to achieve a real return, I need more than 15%. And of course, more than 15% is one thing, but I want to double that, right? I want to have a 15% real return. And to have a 15% real return, I need to have a 30% nominal return. That's why one of the preconditions for any stock, when it enters my spreadsheet, on the day that it enters my spreadsheet, is that it has to be projected to grow by at least 30% over the next 12 months, which all of these stocks either still are projected to grow more than 30%, or when I added them were projected to grow this much. What else do I do on my style of investing that's relevant for me to tell you here? First of all is I use enterprise value over gross profits, because enterprise value is important to me because I want to penalize companies that have a lot of debt. Debt is risky. Debt makes you fragile, and especially as companies need to refinance that debt as those bonds mature, it may put a company in jeopardy if it has a lot of debt. That's why I want to penalize a company that has a lot of debt, and I use enterprise value over market cap. Market cap, back in the day used to be used because it was a proxy for enterprise value, but actually most people agree that enterprise value is a much better way to look at a stock's balance sheet than, say, a market cap. So that's why I use enterprise value. And also I use gross profit because gross profit is only relevant for my style. My stocks are not optimized for earnings. They're only optimized for gross profits because they are stocks that are new, that are early on, whose products are not obvious to most people. And so my style of investing is I try to go in a stock when I see signs that their product or service gets adopted. And I try to exit that stock once I have signs, I see that the product is widespread. The product is widely adopted. Most households have the product. That's when I want to exit a stock. And this is my style of investing. And how do I deem whether a stock is going to be overvalued or undervalued? Well, I deem whether that stock is overvalued or undervalued based on the enterprise value over trailing 12-month gross profit over revenue growth. What this ratio is a spin of the PEG ratio, the price to earnings to growth of Peter Lynch. It's a spin of that ratio adapted to hyper growth stocks, and it answers the question, how much am I paying for each percentage point of forward growth? How expensive is it for me to buy that stock for each percentage point of forward growth? And some stocks are very overvalued per that metric, and some stocks are very undervalued per that metric. And this is where probably what you've been waiting for, which are the stocks that are the most undervalued based on the way I assess stocks. So based on the way I assess stocks, this has been pretty stable for a few months now. The cheapest stock is still Hims and Hers company. very cheap. The stock is misunderstood. It's trading very low because it used to be a SPAC, and the market thinks SPAC equals bad. As simple as that. Then StoneCo. StoneCo is dirt cheap too. I mean, almost as cheap as HIMS. And I don't understand why this stock is trading so cheaply, given that it's going to have nice forward growth, well above 30%. And this is a very profitable company in Brazil. StoneCo is the square of Brazil. The stock is owned by Warren Buffett and Cathie Wood. And this is a company that's been forgotten by the market because they had an issue with their collateral back in 2021, and the market has never revisited that story. And I believe it will one day because the stock is doing very well. The business itself is doing very well. So the stock will do very well because the business is doing very well. The last one is StoneCo. StoneCo is not StoneCo. Lovesac. Sorry, Lovesac is a furniture company. What they sell is they sell bin bags and they sell sectionals, and this is a furniture company targeting Gen Z and millennials. And this has been a fairly popular company among that segment, but the market has sold off this company to crazy, unreasonable levels. This is a company that's trading below gross profits, for example. And the market is obviously thinking that this company is going to die because it sells furniture, and of course, nobody's ever going to buy real estate ever again. That's essentially the reason. That's how I explain Mr. Market. Now, what about the stocks that are the most expensive right now? Shopify and Nvidia are two stocks that I've sold that are the most expensive right now. Now, if you've been following this spreadsheet for a while, if you've watched one of my prior videos, you may be surprised to see that Nvidia, compared to what it used to be in these spreadsheets a few quarters ago, Nvidia is now still overvalued, but not that much. Not that much. This is a stock that used to be well into the 3s and 4s. But when you update the forward growth of that stock, it's important to note that much of that crazy valuation of Nvidia is actually warranted by the market, warranted by the future growth. This is stunning for a company to grow this fast at this size. And this is why I would not fault anybody for owning Nvidia, in my view. Again, this spreadsheet is not about the best stocks to own. The spreadsheet is only about which are the stocks that are the most undervalued right now. That's the goal of the spreadsheet. So what I do now is I go for each mega trend, and I'm going to walk you through each of the stocks briefly, a few sentences per stock in each of these mega trends. So let's start with the first megatrend, which is the energy revolution stocks, the electrification stocks. The world is getting electrified. Oil and gas is going away. Of course, when I say that statement, a lot of people disagree. That's because we're early on in the product adoption. We're early on in that service adoption. Tesla, for example, almost now, but only 5% of all of the cars sold are Tesla. This is a stock to me that will not have a hard time increasing that market share quite a bit until 2030. Tesla is a stock who has given us a long-term guidance for the electric vehicles that it sells. We know the long-term guidance is 20 million cars by 2030. And Elon Musk also has given us a price target at $5 trillion. And so we have a lot of long-term elements on Tesla, which in my view reduce the risk, which is why for me Tesla is my largest position at more than 30% of my portfolio. And Tesla stock has been trading healthily recently. The stock has had a healthy valuation. It went back up quite a bit, and right now it's going back up slowly but surely at $256 bucks a share, which gives it a $759 billion enterprise value evaluation. So this is a stock that per my spreadsheet is getting a little bit expensive right now, but as far as the quality of the company, I have very little doubt about this company in the future. This is no investment advice, of course, but I have very little doubt, and I'm very hopeful. Hope based in facts, of course, but I'm very positive about the outlook for this company. What's another stock in the energy revolution stock? It's Enphase. So Enphase is in a duopoly with SolarEdge. Both of these companies pretty much own the residential market. The reason why I invest in Enphase is because I believe that most residential homes in the future will be covered in solar panels. Could it be 90% by 2035? Could we have 90% of single-family homes? Well, that would be optimistic, but that wouldn't be too far-fetched, in my view, because solar is, in my view, going to be as pervasive as air conditioning or as an ice making machine in your fridge. This is kind of the analogy that I have for solar, because solar is the cheapest source of energy anywhere around the world. And as we do solar today, it's very important when you follow solar to update your lenses to September 2023 and not use, lenses from January 2023. Because if you use the lens of January 2023, information is outdated. This is a field that moves very fast. The truth is, when you oversize a system of solar and you put more, you size a solar system for the worst 2 weeks out of the year, and you make sure that those worst 2 weeks out of a year, you generate enough electricity for your household use. What you have is you have excess energy for the rest of the year, and it makes solar viable. It's noteworthy that most single-family homes have enough roof space for solar. Solar is getting better. It's getting more and more efficient. Panels are leaning towards 500 watts. In a couple of years, a panel about the size of a sheet of plywood will be 500 watt peaks, which is more than a doubling compared to what they used to be just 10 years ago. So this technology, to me, I have very little doubt about the total addressable market going forward. And I own Enphase because I think Enphase is the best technology on one of the components in the space, which is the inverter. And they have developed microinverters, and I think that's a superior technology. So that's why I own Enphase. Then STEM, let's talk about STEM. So STEM is a small cap that I own. It's not a big position for me. It's one of my itchy fingers type of stock where I gotta stay busy. And I'm happy to own STEM. STEM is an installer of Chinese megapacks and Tesla megapacks. They install these megapacks for utilities behind the meter and front of the meter, also for industrial sites. And they're mostly an engineering firm right now that sets up these systems and installs them. And it's growing at 87% growth over the next 4 quarters is what analysts estimate. Now, the gross margin is low right now because, of course, they operate in the hardware space and the installation space, the design space for the moment. But whenever they sell a battery pack, they attach their maintenance contract and they attach their software contract. And that software contract has 80% gross margin. So in the future, as more and more of the revenue comes from these long-term maintenance and those long-term software contracts, this company should see its gross margin trending upwards. And I'm very positive about this company. And this is a very cheap company, in my view, when you consider that it's growing at 87%. Very few companies do that in this environment. It is a stunning rate of growth. Moving on to the most undervalued company of this spreadsheet, which is HIMSS. HIMSS and Hers Health. So what is HIMSS? HIMSS is an e-doctor, a digital doctor, and a digital pharmacy in your pocket outside of the healthcare system. It is healthcare that you pay on your own out of pocket. And that healthcare has a few specifics in the sense that it is oftentimes cheaper than your copays. It's a big deal. It's cheaper than your copays with a regular insurance. And that's actually the more minor selling point for HIMSS. The major selling point for HIMSS is the time saving and the ease of use. It is making getting treated for an issue as simple as it is ordering on Amazon. You get the app, you download the app, you see a doctor, the doctor diagnoses your issue, and then the app sends you the medication for your issue. Keeping in mind that between 60 and 70% of conditions are treated with medications and medications alone, so they do not require a physical visit to the doctor. A big cost-breaking practice of HIMSS is also the follow-up. HIMSS allows you to follow up with your doctor and follow up your prescription easily, which breaks rent-seeking from most doctors. Most doctors engage in rent-seeking in that if you want to have a prescription extended and you want to stay on the prescription, they want you to come back and see the specialist and pay $200 to see the specialist. That's how most of the rent-seeking works in that space. HIMSS has a messaging app. HIMSS allows you to be followed by your doctor after that initial appointment and after that initial visit, which is very important. It increases adherence to care. It increases the odds that you're going to get your minor issue cared for. It increases the speed. It reduces the cost. In my view, HIMSS is the future of healthcare, and I'm very happy to own HIMSS, very much so. Moving on to big data and data stocks in general. So we have data warehouses, data lakes, data monitoring. I have 4 stocks in this space. Noteworthy to say that these stocks, aside from Datadog, which is okay as far as valuation goes, these stocks are getting expensive right now. The AI wave is built on top of these companies. AI-run businesses will be run on data storage businesses. And if you take a company like Snowflake and a company like MongoDB, so Snowflake is storing data in the form of a SQL database, i.e. a columnar database with columns, right? MongoDB is storing data under documents, right? And it's typically a JSON file, so you'll store data with documents. So the main distinction is that MongoDB is typically going to be used by people who want to code apps, develop apps, but are not data scientists. And Snowflake is going to be used by also people who want to develop apps, but also happen to be data scientists. So that's the big distinction between both of these stocks. But the question is, as we have more AI, as we have more apps, those apps need to access that data, and that data is stored in the cloud, and it could be stored in a document database like MongoDB, or it could be stored in a columnar cloud-based database like Snowflake. And so these are a very big deal. These companies are a very big deal, and they're growing very fast at 31% and 43%. Now, Datadog is a little different. Datadog is a company that's an enterprise application monitoring software, and it allows you to monitor whenever there is an issue in your software stack. So companies will tend to have multiple softwares connecting to each other. And whenever an issue arises, let's say there's a customer order and the order didn't come through a mail, well, there's an issue somewhere in your software stack. Datadog allows you to detect where that problem is. So that's why Datadog has a little bit of a cybersecurity component to it. A very interesting company, very unique niche. Lastly, Palantir. Palantir is also a niche business. Palantir is doing really well in the military. It is selling its operational software, Gotham, to the military, and that's still their bigger business. They have a smaller business, Foundry, which business is getting a lot of hope on the internet, and a lot of people are very excited about Foundry. But Foundry's adoption right now is taking a breather, and to me, this is a stock that I own mostly because of a military business, which I consider to be a monopoly for Palantir. A monopoly providing defense intelligence, running the defense intelligence for the U.S. military and the West in general, and this, in my view, puts Palantir on track to become one of the top 4 military contractor. And of course, if you're going to be a major military contractor, your market cap is going to be in the hundreds of billions and not in the tens of billions like it is right now. Lots of people like Palantir too because they hope that it gets in the S&P 500. And I think it's a nice aside note here because Airbnb just got into the S&P 500. So I'll talk about it in a second when I talk about Airbnb. So these are my data warehousing and my data monitoring stocks in a nutshell. Then we have cybersecurity. So cybersecurity, I have CrowdStrike, Zscaler, and Cloudflare. So let me just say Cloudflare, somewhat of a more expensive stock. What does Cloudflare do? Cloudflare is it's a firewall for websites. Is how I describe it. It allows you to hide the IP address of a website so that you can't have a DDoS attack, so that your website is protected. And Cloudflare, of course, has grown to much bigger proportions and now offers many related products that need a unique data center infrastructure like they have. They find it useful. For example, Cloudflare is trying to implement zero trust thanks to their infrastructure. And this is why this is a stock that has a little bit of a community behind it. Actually, this is a stock where our community is almost a little tribal behind it. And people get upset if you ever criticize Cloudflare for some reason. They get upset. So it's got a big following, this company, but it's the more expensive of the cybersecurity stocks. CrowdStrike and Zscaler, in my view, work together. So the reason why I own CrowdStrike is because I believe cloud-based antivirus, I'm going to call it an antivirus, cloud-based antivirus, you're going to have one winner in my view, and that winner is going to be the one that has the most data. What CrowdStrike does is that whenever one of their Falcon software installed on any endpoint devices, i.e. a car, a phone, a laptop, whenever one of these endpoint devices catches a virus, CrowdStrike detects it and broadcasts to the cloud the cure to the virus. But of course, it's all about having a bigger network. And CrowdStrike, in my view, is the bigger company in that space. That's why I believe they will win over SentinelOne. A question I often get asked too is, what about XYZ company. Palo Alto Network is often said, for example. And the reason why I like CrowdStrike is, of course, because CrowdStrike is a fully software company. And software companies tend to grow much faster than companies that used to sell hardware and try to add software to their hardware. At least that is my view. Zscaler is a company that prevents the spread of an infection in a device to other devices. So that's zero trust security, which means that no devices connect together without having a security check and a secure connection. And this is what Zscaler does. It allows for devices to connect to each other securely. And therefore, what that means is that if back in the day a virus could infect your entire hospital, your entire state, your entire company, doesn't matter. Today, it's much harder to do because each device is quarantined from one another. So you can infect a device, but the whole system will be protected because no connection between devices doesn't happen without trust. There is no trust anymore between two devices. That's why it's called zero trust security, and that's why it's called Zscaler. So these are our cybersecurity stocks. A note about this megatrend: cybersecurity needs to move online, needs to move to the cloud. We live our lives digitally, and therefore security is not the mall cop, the mall security guard anymore. No, security now moves online. And that's why these companies are part of a megatrend, which I believe we're still very early on. Megatrend that has been around for a little longer is e-commerce. So MercadoLibre, Shopify, and C Limited. Shopify is a very expensive company. Rightfully so. They have a lot of good things going for them. Shopify Pay. The more recent good news, for example, what Shopify was the partnership with Amazon in the US for the shipping network. And I think this is a major selling point for Shopify. And of course, the stock shot up on the news because they were trying to develop their own shipping network. Now they've partnered with Amazon. Also very telling how, the financial community keeps telling us Shopify is the Amazon killer. Shopify is the Amazon killer, right? The assumption is that you're going to have competition. And then you see Shopify partnering with Amazon. You see modern day businesses, 21st century businesses don't always assume competition is the only way to go. In fact, they don't always compete. They co-opete. They go after the customer together. They don't destroy value by going in an all-out war against each other. It makes sense. This partnership between Shopify and Amazon makes a lot of sense for both parties. And I love it. I love it very much. MercadoLibre, not much to say about MercadoLibre. I've done a few videos about MercadoLibre. MercadoLibre is the Alibaba of Latin America. They understand this market. They are doing very well in this market. They are succeeding where others have failed in this market. For example, C Limited did not do too well in Brazil. Now, C Limited is a stock that I've been disappointed by, mostly because they didn't invest, right? They have a bunch of cash flows and they don't invest those cash flows. But that appears to be changing. But there's 2 points to say about C Limited. First of all, they're finally investing in their infrastructure in Indonesia for Shopee, which is great. It's wonderful. My issue is that they should have done that 2 years ago and not today, because now they're having competition from Lazada of Alibaba and also TikTok Shop people shopping on TikTok. That's a big competition. So, and that's bad. Now, on the other hand, there's been a good news on C Limited, which many of you have asked in the comment section. If you watch this channel, Free Fire, their game, is back, and it's allowed again in India, which means that 1/3 of their business is that gaming division. That gaming division may see a stop in their customer bleed. They may see the customers return, and that, my friends, require full analysis. So I will make a full analysis about this, trying to see whether that video game can make a comeback, because it's noteworthy to say that one of the reasons why this stock was trading so high is because they had the most popular game in the world. And that game got banned. And now that game is not banned anymore in a country of 1.5 billion people. So that could be really good news, and I'm going to research it a little more. Let me move on to the payments. Not much to say about the payment space either. DLocal growing at 54%. DLocal specializes in payments in emerging nations with a specific focus on payments between online Western companies like Microsoft, for example, that sell their products to developing nations. They'll often go through DLocal. DLocal is a way for these companies to offer a form of payment that local buyers really enjoy in those different emerging markets. And they have 30 plus different emerging markets. DLocal is a company that has a new co-CEO that was at MercadoLibre. And the market is very hopeful that this company is in for a rebound. That, however, in my view, is somewhat reflected in the stock price, which is not the cheapest, or at least not as cheap as it used to be. I got used to this stock trading in near $10, right? It's more expensive now. So StoneCo, I've described to StoneCo at the beginning of the video a little bit, but StoneCo or Stonia in Brazil, what do? They are the Square terminals, the payment terminals in a lot of small businesses in Brazil. You have tremendous amount of small businesses in Brazil. StoneCo is in nearly 3 million small businesses, and these payment terminals, they help you accept credit cards. Credit cards are very popular in Brazil. They also help you accept other forms of payments, like the new Pix system of Brazil, which is their version of a CBDC, their Fed now. Again, very popular stuff. StoneCo is still growing at 40% in a country that just started dropping interest rates, in a country with a more youthful population that spends more with greater velocity of capital, right? Money changes hands more often in Brazil than it changes hands in a country whose average population is older. And so I love StoneCo very much, and it's a dirt cheap stock. So I'm happy to own this company. Then Square. About Square, well, one thing I have to say about Square is I'm a little disappointed. That growth has stalled. That growth is disappointing. Granted, PayPal's growth is just as tiny too, but these are companies, whether Square or PayPal, where I think a growth investor needs to stop looking. When it entered my spreadsheet, this company was growing at well over 30%. The growth has stalled. This is kind of this is a situation when many of the Cathie Wood stocks, for example, are in. And so Square is kind of a question mark for me right now, because it's not cheap, given that the growth has stalled this much. The gross margin is not that great, but they have a leading app in America for payments. Which just eats Venmo for lunch and dinner, and that app is Cash App. Cash App is everything today. Contractors want to get paid in Cash App. Your lawn guy gets paid in Cash App. It's so pervasive in the US, the Cash App. If you don't live in the US, I'm telling you, their app is a quasi monopoly. It's extremely popular, and I love it very much. I think it's a great app. So, okay, moving on to the chip makers. What are the chip makers? We have AMD, Indie, and Nvidia. Let's talk about AMD and Nvidia first of all. Nvidia. As intimated earlier in the video, Nvidia is expensive, but it used to be much more expensive. When you update the growth, and this is the analyst number, it's 41% analyst number, is what they say, and they're probably way off again. Like a more fair number, maybe 60-70%. And if it's 60-70% growth over the next 12 months, this is not an expensive stock. Nvidia is a bet on how much that growth is going to be. How much do we think that data center growth is going to be? It's a tough one. So it's a very tough one to know, and I think this is one of these stocks where you have to be an insider. You have to really know the product very well. You have to have used these graphics cards before and know how much better they are to the competition in order to be able to hold on to Nvidia at these valuations. I did not. I find Nvidia too expensive. AMD is getting expensive. AMD is getting overheated in my view, and it's getting expensive and overheated based on the hope that they will come up with a solution to Nvidia's lead. And they will come up with a product that competes with Nvidia. Historically, AMD has been the more diversified company out of the two. But they really need to come up with a product, and AMD has promised a lot, but we'll see whether they deliver or not. And I think this is a stock that's very expensive because you're betting on the fact that AMD is going to deliver and that Nvidia is not going to be a monopoly. That's kind of a more of a value-oriented bet, if that makes any sense. In the way of thinking that many value investors do is they've been around for a long time, they can totally innovate. We don't know. We'll see. Now, how about Indie? Indie, not much to say. It's a small stock. What they do is they focus on semiconductors for companies that compete against Tesla. AMD is heavily undervalued. It's growing at almost 100% over next 12 months, according to the analysts. Heavily undervalued, in my view. The gross margin is actually pretty good, given the small size of this company and given the hardware space. And what they do is they do entertainment system for companies that will compete against Tesla and develop electric cars. They do drive assist systems or sensors for drive assist system. They do Apple Car Key system to enter your car by scanning your phone. All of these specific semis. And of course, the risk of investing in a company like Indie is you are operating in the shadow of Tesla, and you really don't know whether those other car makers will be successful or not, which is why this stock is very dirt cheap, in my view. Okay, moving on to my lifestyle stocks. So megatrends are there's a lot of technology in the megatrends. They're mostly technological, but not only. Another megatrend that you often find is lifestyle. Lifestyle stocks I like very much because culture changes very fast. And when you see a company like Celcius and how successful Celcius has been at getting its beverage all across the US, I mean, hardly do you go into a grocery store without seeing Celcius at the cash registers now. They're everywhere. They're absolutely everywhere. And I know in Europe it might seem very weird because in Europe it's nowhere. I was in France a month and a half ago. It was nowhere. And in the US it's everywhere. So the big question is how much more can they grow in the US? Well, the answer to that, in my view, is quite a bit, because we're beginning to take market share from Monster beverage, and we're beginning to take market share from the traditional sodas. And of course, the long-term enemy of any energy drink, is coffee, right? All of these drinks kind of compete together against coffee. And so Celcius, of course, is taking market share from coffee, but you have a much better margin than coffee with this type of product. And so this is a company that's catching the attention of a health-forward millennial and Gen Z consumer, and we'll see how this goes. But if someone thinks beverage companies are really awful to invest in, my suggestion is to look at the long-term returns of Monster beverage. And is Celsius Holdings and over Monster? No investment advice, but this is a stock that I own. This is a stock that I like, and this is a stock that capitalizes on cultural trends, and those cultural trends can shift very fast. Lovesac's competitor, in my view, is Lazy Boy. So if you live in the US, you may know that Lazy Boy is kind of this renowned American brand, but they're not doing too well, I would argue. They have brick and mortar stores that are very expensive to run. Their method of selling is very 20th century with commissioned sales folks, and of course Lazy Boy is very famous, and they do recliners and they do sectionals. That's what Lazy Boy does, and that's what Lovesac is trying to disrupt. And Disrupt does sectionals in a way very different than, say, your classic Lazy Boy sofa. They do it in a way that can be reconfigured in so many different things, including beds, including things for dorm rooms, etc. And of course the recliner versus the beanbag. When you study the furniture trends, one of the questions to ask yourself is, where is the millennial and where is the Gen Z headed? What is Gen Z millennial more likely to like? Is Gen Z likely to enjoy a recliner like our parents did? Well, my parents are not from the U.S., but U.S. parents love recliners, so it's a thing, right? And I think they have a shot. Figs, another lifestyle trends. So Figs is trying to pull off what Lululemon did for scrubs, and so they are trying to make scrubs fashionable, and Lululemon took the athletic wear of yoga pants and made it fashionable. Figs is trying to do the same thing with scrubs, and they're trying to make it fashionable. And this is a company that is also dirt cheap along with Lovesac. Now, Figs, the reason why the stock is down and the growth has stalled may be a little more idiosyncratic in the sense that, of course, they had a great 2021 and a great 2022 selling scrubs, i.e. healthcare. But this is a stock, in my view, that may rebound. Moving on to my cloud stock. And my cloud stocks, really, I can't invest in Amazon or Google. They don't grow fast enough. I mean, their cloud divisions grow fast enough, but these companies are so huge, it doesn't really move the needle. So I have to find pure play for cloud. I have two pure plays in the cloud. DigitalOcean. DigitalOcean is a cloud setup that's less expensive than an AWS or an Azure, and focuses on small businesses and small scale developers. And so they have a very interesting niche. You know, their average bill is something like $50 a month. And they're bringing the cloud to really the world of small enterprises, the world of small developers. And Axon is a cloud business now. Of course, they got started with over tools, but now they are a cloud business. And now, to me, the story of Axon is storing these footage that police officers record as they pull over people, etc. Those footage get stored on the cloud, and Axon is, of course, providing that cloud. And I think it's a very interesting niche, that business growing at 38%. So the growth is unabated. And Axon is one of these companies that has an outstanding return over a long run. Moving on to the neobanks. So in the neobanks right now, SoFi is cheaper. Ever since a Nubank reported, I've changed the metrics, right? Their metrics have changed a little bit. And because of that, Nubank is a little more expensive than SoFi right now. So I'm actually refocusing my buys on SoFi right now. You know, I really go back and forth between the two. Whenever I go in those two, I always say I can't choose. I really can't choose. I mean, they are so close. Like SoFi, of course, it's got the advantage of a more affluent consumer, the ability to sell more services to a more sophisticated consumer that's gonna spend more money, so you're going to have a greater take rate on these cars, greater opportunities to refinance loans at larger amounts, right? So these are all the good things going for SoFi. Now, the downside of SoFi, of course, is that it operates against legacy banks. Everybody already has a bank in the US, and so SoFi does not have the tailwind that Nubank has, which is Nubank, most of the time when it signs up a new customer, it's their first financial institution. Nubank becomes the first financial institution of that customer, which means that Nubank can grow much faster, even though the ARPU, if that makes some sense, or the amount of money that they can extract out of each user through various services is much lower for Nubank. So it's really a trade-off between the two. Right now, I'm needing a little more like on SoFi, but really, week after week, I can't decide. I like both stocks very much. Okay, now off to the last but not least, which is my platforms. So, Rover is a stock that I have just added, and I'm very happy with Rover. Rover is a niche company. It's Airbnb for pets, Airbnb for dogs, and it is a niche company. The growth pattern of Rover should be pretty similar to Airbnb, because people typically need Rover when they go on Airbnb. Right? When they go on Airbnb, they need Rover because someone needs to look after their pets and after their dogs. And this is a company, from the research I've done, is heavily loved. People love Rover, just like people love Airbnb, just like people love Amazon. That's what marketplaces do. That's what platforms do. Platforms are loved. And this is a company whose growth is unabated. And this is a company, in my view, for Rover, they just started going into Europe. And so Europe, maybe a major wave of growth. Also, they have about 4 million households that use Rover on a recurring basis today. And of course, there's more than 135 million households across the US, Europe, and Canada that could become their customers. So this is a company, in my view, that can 10x its customer base without too much of an issue. And I'm very happy to own it, especially at these valuations. We're getting a platform. Platforms are the best business model out there, right? You don't have to make the product. People who register on your platform make the product. Sellers on your platform make the product. Best business model out there, in my view. And it's trading almost 3 times cheaper as Airbnb. And Airbnb, of course, today, you will find it more expensive today because it entered the S&P 500. And the stock was up more than, I think, 8% today because it entered the S&P. So goodbye, me calling Airbnb cheap. And I have been calling Airbnb cheap on this spreadsheet for how many videos? Maybe 10 videos. I've been saying it's cheap. It's not that cheap now. And who knows how high this is going to run, as institutions now have to buy Airbnb. You have no choice. It entered the index. All of the bogleheads, the Jack Bogleheads, well, now these index funds are going to have to buy Airbnb. That's how the market works. So you're going to have an even stronger institutional base. That's going to make the stock less volatile, which means less opportunities to accumulate. And I have what I'll call a full position. I have a good position on Airbnb, so I'm very happy about that. I believe this platform is part of a revolution, of course, of hotels, and they have a long way to go in disrupting hotels, by the way. But also mom and pop landlords is what I think is the bigger story of Airbnb. Is that eventually they may disrupt mom and pop renters with flexible leases, and I'm very hopeful for this company. Very happy to own it. So this was not investment advice. This was just entertainment. I hope you were entertained. No investment advice ever on this channel. I really hope you'll consider subscribing if you like some of what you're hearing. That's why I do these videos for exposing the channel to more people. I certainly hope you'll like the video. Please follow me on Twitter, X, that is, if you can. Have a wonderful day, and thanks for watching.